This is the 26th annual conference, and this is a big deal for you. You put a lot of effort into this conference every year. Why don't you explain to people what it is and why you get folks together?
What we're trying to do is let people understand that when they invest with us, then they're not investing in us, they're investing in the companies that we choose. So we keep investing in our business by hiring and training and retaining people so they can identify these businesses that are going to grow a lot and that there's something about them that's competitively advantaged. And we can hold them a long time. So our average holding period for our funds is 8 years maybe, and for Barron Growth Fund, which is the fund I manage, which is the largest, it's 14 or 15 years. Publicly owned companies, 14 or 15 years. And what's really cool about that is that, even better, is that that fund has outperformed the market by about 500 or 600 basis points a year since its founding in 1994. Number one of small cap growth funds.
Which means what in terms of overall growth over that time period?
Compounding is 13 some odd percent, and the index that we're competing against is 7. And it's with 80% of the volatility. So what we're trying to do is show people that it's not really us, it's all these companies that we've invested in for the long term. And that's what their money's invested in. It's invested in those kind. And then we want to let them see these executives, look them in the eye, see if they feel like they're smart, if they're honest. There's this lizard-like gecko type, gene that you have, which lets you understand if people are honest or straight or smart, and you can figure that out. And we want people to see these executives and do that for themselves.
The theme for the conference
and thank
this year,
them.
The theme for the conference this year is disruption. How did you come up with that theme?
By reading the papers and by understanding what's going on in the country, and everything is changing, and you have political norms that are being disrupted, and you have, there's a lot of parts of foundational elements of our democracy which are being attacked, whether it's freedom of the press or freedom of speech or freedom of religion. So a lot of these things are under attack, and that's very disruptive. So that's where the idea comes from. And then when I was thinking about that, I started thinking about, well, gee, this is sort of like what happened in the 1960s. And in the 1960s, you had Vietnam, you had civil rights, you had women's rights, you had marches on Washington, and you had all these things, and you had this very rough assassinations of President Kennedy, his brother, Martin Luther King. So incredibly disruptive period. And then a few years later, you had an impeachment of President Nixon, or he resigned before he was impeached. So I was thinking, okay, so this is like the 60s, which
Are you painting that to what we're seeing today with politics? Because I thought you were coming at disruption from like positive disruption, companies that are disrupting, and as a result, kind of getting ahead of their competitors.
Well, the point that I make is that the positive disruption you're describing comes from this incredible disruption in society which is happening all around us. And in fact, so I looked at this period, 2017, as also a very, very disruptive period, not just with the politicians that we have now, but if you think about 9/11 and you think about the Afghanistan war and Iraq, you think about all the things that have happened, the financial crisis, almost a depression. So you think about all those things and you say, oh my God, this must be awful. No wonder stocks are, why are they keep going up? And that's for 17 years we've been in this period. And then you go back to the 60s and you see the same thing. And then you go back to the 1930s and 40s and it was the same thing. So from disruptions, that's what creates opportunity. That's what creates ability for growth. And that's what I want to talk about today.
The market has been phenomenal if you're looking over the last year or since the election or what we've seen taking off. But you've told us in the past that when you look at stocks, you could see 35 to 40,000 for the Dow by the year 2030. You now think that is maybe a lowball estimate.
That may be a little low. The way I think about it is that we were talking about it then, market was maybe 18 or 19,000 on the Dow, now it's maybe 23,000. And what I've been thinking about is that the Dow Jones, as a shortcut, you sort of compare to the GDP of the country. And they were both, the economy was 20 trillion and maybe the market was 18 or 19 trillion, so it was a little bit underpriced. Now the economy is a little bit over, the market's a little bit over that. But the idea is that the stock market relates to the economy. Sooner or later, they get to the same place. And not at the same time, but they get there at the same place. And what happens is that sometimes it gets out of whack, and sometimes the economy just keeps growing and the market doesn't, or sometimes it gets, but at the end it's the same. So that's somewhere around 6 or 7% a year, including inflation, 2 or 3% real, 3 or 4% inflation. People say there's no inflation. That's ridiculous. Of course there's inflation. Just think about the things you buy, think about salaries, think about anything you want. But it's 6 or 7 is the economy. That's a double every 10 or 11 or 12 years. That means the stock market doubles every 10 or 11, 12 years. So what I was thinking about 2030 is the stock market would have been somewhere around 40,000 compared to 20,000 at the time. Now I think that might be a little low because the interest rates are so low, and because I think growth is going to be faster than it had been in the past.
Why do you think growth is going to be faster?
Well, there's a couple of really important factors that, well, three, that since 1973, that's when OPEC raised the price of oil from $10 a barrel to $30. That's the oil embargo. People waited in line, and so that really messed up our economy. And then now the price got as high as $147 a barrel, 10 to 30 to 147 in 2008. So what that is, that was a big penalty on our country for growth. That was number one. Number two, interest rates. When I started in business in 1982, interest rates were 18%. Now they're almost nothing. Now you have the banks have all been recapitalized. Lots of capital is available at very low cost. So capital is not a constraint on the economy. Plus, you have businesses, because of technology, that are becoming capital light. And then you have technology, which is reducing costs for businesses and making a lot of new businesses that hadn't existed before, and you get a lot of extra services that you didn't have before. So essentially you have low cost energy, low cost money, and you have technology driving everything. That's on the positive side. And the other side is the value of your money. Everything you keep in your pocket, everything you keep in your savings account, that's falling in value every single day. And so the only thing you know for sure, you don't know if the market's going up or down, but what you do know 100% is the value of your money is going down. And so what we think about is just taking the value of your money, taking money that's sitting in the bank, that you know is falling in value,
money if it's sitting.
and you're losing,
Yeah.
and take that money and buy something that's increasing in value. So you're protecting yourself. That's the concept.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.